Good evening, everyone, and welcome to the second webinar of the series from VCL Vintners. We're just waiting for a couple of other people to jump into the room, and then we'll get going. Just want to introduce Simone as well, who will be talking us through the tax laws in the world of whiskey. And giving us an insight from more of a legal perspective as well for everyone. So as normal, just feel free to pop a question into the chat room and we'll get to those at the end of the webinar. Just going to wait sort of 2-3 minutes to get a couple more people in and we'll get underway. But yeah, welcome Simone as well. Good to have you on.
Thank you. I hope we don't get disturbed by my children or dog, but we'll see how it goes. That's the pleasures of working from home.
Indeed. Okay, we're just gonna give it a minute or so and we can get moving. Right, just watching the people count us slowly.
Do they get a reminder to say it's
They should do, yeah. We should have a reminder. I think what we'll do is we'll get underway and then people can kind of jump in as and when they can. And guys and girls, as I said, feel free to jump in with any questions at any point, and we can get answered to those around the end as well. All right.
And is this being recorded? Are you recording?
It is recording now. Yes, yeah. We are recording now as well. Okay. So whiskey is a tax-free investment. So if anyone doesn't know, VCL as a whole, obviously we are a whiskey cask brokerage. We were the first people to ever broker a cask of whiskey all those 12 years ago. We're still standing now and currently managing a portfolio between sort of 75 to 80 million pounds worth of whiskey. You can find us featured in all of the articles and news forms above. So from the City AM to the Telegraph to the Independent, Hargreaves Lansdown, etc. And then in terms of our accreditations as a company, we're part of the Live X100, which is a trading platform for fine wine and spirits. We are WSET registered brokers over here as well. So all of our staff are WSET registered at least from level 1 up to level 3. We have a WALGA license, which allows us to buy and sell alcohol within bond without any tax, VAT or duty attached, which can be very relevant in this conversation. We obtained that from HMRC. And we're also members of the WSTA as well, which is the Wine Spirit Trade Association. That will be a regulating body, anything from sort of shop bought level whiskey all the way to the highest point at investment level as well. So if we get straight into it and look at sort of casks as a wasting asset. So whiskey as a wasting asset, first of all, that is how it is deemed from an investment point of view and from a tax point of view. Now, that essentially means it has a shelf life of 50 years. Now, technically, it can go on for longer than 50 years. As we know, with some of our casks, we have 52, 54-year-old casks under our books as well, which still are deemed as investment-grade quality due to the high levels of ABV. And that will still keep it completely tax exempt from that point of view. Anywhere in the UK, no matter where you live, this will be exempt from capital gains tax because it's deemed as a wasting asset. Okay. Now, your other side of that is what we call the angel share. The angel share, there is various things you can see online. There's a YouTube video which lasts for about 15 minutes and it discusses the angel share and the details beyond that as well. But your angel share is the evaporation of liquid. Essentially, year on year, some of your cask will evaporate the liquid due to the wood it's made from and it's being porous. It's roughly 2% a year. So 2% a year you will lose in your cask. But because of that loss, the government will recover it by putting no CGT on the investment at all. So we then look at how the casks compare across the board to other tax areas. Property, you will be charged capital gains tax on sale or on any rental income. Savings accounts, they are also taxable on income tax. Shares, you will have any capital gains tax on any shares, any profits you take on those shares as well. And then from a digital assets perspective, any sale will have capital gains tax on, as well as any income tax as well. Any earnings you make on a digital asset will also feature a taxable clause in there as well. In comparison to casks, as you can see, there is no capital gains tax, as I said, on your profits, and all of the above will feature some form of tax, whether it be on a sale, rental, or income tax point. Well, that's me done there. That was very, very quick and easy. One thing I do want to mention as well, in regards to tax, to cover an overview there, is your casks are all stored in bond. The cask being stored in bond in a bonded facility within Scotland, we use many different bonded warehouses, will keep it exempt from tax, VAT, and duty. So as long as the cask remains in bond, it will also be exempt from any tax, VAT, and duty as well when you buy, hold, and sell. So that's just an addition on top of the capital gains tax side. So that means this investment is completely tax-free from every aspect. That's everything from the VCL guys over here. So I'm going to pass you over to Simone now. Feel free to fire any questions, as I said. And Simone, away you go.
Thank you. Thank you for inviting me. So Dylan's obviously just given a very sort of brief overview of how the tax works. And I'm going to go into a little bit more detail about capital gains tax as a whole, and then specifically about whiskey casks. So some of it will be a little bit repeated. So that's just a summary. Right, so capital gains tax is a tax on the increase in value of an asset between the time it's acquired and the time it's disposed or deemed to be disposed of. Capital gains tax, as the name implies, is a tax on capital gains. It is therefore not charged on gains which are assessed to either income tax or corporation tax. If you do plan to hold your investment through a company, we can help you with that, but that's not part of today's webinar. In the UK, capital gains tax is charged on capital gains made during a tax year. The tax year in the UK runs from the 6th of April to the 5th of April. We're very unusual in that respect, because most countries do run 1st of January to 31st of December. Every individual is entitled to an annual exemption, which currently is £12,300, which means your first £12,300 of capital profit made in a tax year is exempt from tax. In order to be a chargeable gain, there needs to be all three of the following. The first one being a chargeable person. This is someone resident in the UK. Second is a chargeable asset. So this is all property, whether located in the UK, unless specifically exempt. And then you have a chargeable disposal, which is when there is a change of ownership. Sorry, I was getting used to doing the slides. Okay, so the calculation of capital gains tax. So this is just general capital gains tax when you're selling an asset. This is not specifically to do with the whiskey casks. So the date of disposal is the date when the contract is made, which is usually when money changes hands. The proceeds are the amount that you receive. If the asset was received as a gift, the proceeds would be the market value at the time of transfer. The cost is the actual amount paid when the asset first came into possession. If the asset's received by way of inheritance, which I will talk about later on, then the cost will be the value included as part of the estate. So often it's higher than the original cost when it comes to investments. Any additional costs can be deducted as part of your capital gains calculation or management fees. However, there are exceptions to the main rules. And for capital gains tax, there are some special assets. One category of assets is called a chattel. Pretty slides. Right, so a chattel. A chattel is an asset that can be moved, seen, and touched. So some examples I've put on the slide here. So you've got household furniture, paintings, antiques, crockery, china, cars, plant and machinery. Chattels have their own rules, which are different to the general capital gains tax rules, which I previously mentioned. So with a chattel, if the proceeds you receive are not more than £6,000, then you don't pay capital gains tax on it. If they are more than £6,000, then there's a calculation you need to do, and some of the proceeds, and this is not profit, this is proceeds, so it's the amount you receive, then there's a calculation and some of it would be chargeable to capital gains tax. An example of this would be bottled wines and spirits. So I'm not talking casks here, I'm talking an actual bottle. If you disposed of a bottle that was for more than £6,000, you would pay some capital gains tax on it. If you had a single bottle that you disposed of that you sold for less than £6,000, you wouldn't have capital gains. And these are a different set of specific rules. It gets quite complicated. Again, if the bottles are disposed of to the same person, they could form a set, and there's different rules for that as well. HMRC do have specific guidance that they publish, and a lot of that they talk about wine, and they talk about wine vintage and being in the same year and from the same vineyard. Similar rules can apply to whiskies, but again, this is more from the bottling side, not the cask side. But I just thought I would mention it. So yes, you've got disposal of a single asset forms part of a set. If an asset is a business asset, there's different rules again. So wasting assets. So this is what Dylan mentioned before. So the casks form something called a wasting asset, which again has its different rules. So a wasting asset is one that has a predictable life not exceeding 50 years at the time it was acquired. So that's, I've put the quote there from where in the tax legislation that actually comes from. This means that any asset which is considered to have a predictable useful life of 50 years or less is considered to be a wasting chattel. It's to do with the nature of the asset and considers the intended use of the asset at the point it was acquired. So as Dylan said before, although some whiskies can last longer than 50 years, at the point they get put into the cask, the intention is that they won't last longer than 50 years, and that's why they still are considered a wasting asset, because it's to do with the nature of the asset at the point it begins its life. So an example of a wasting asset are racehorses, some fine wines, clocks, watches, trains, boats, yachts, cars. Okay, so the whiskey casks that are here are stored in oak barrels in government-approved bonded warehouses. When whiskey is stored in the oak barrels, there is the evaporation known as the angel's share. This accounts for about 2% of the whiskey cask volume a year due to the cask and the environment the barrels are stored in. For this reason, for UK tax purposes, the whiskey in the cask is considered to have a life of under 50 years and therefore exempt from UK capital gains tax under the wasting chattel rules. Although some bonded warehouses have conditions allowing the casks to retain some whiskey longer than 50 years, this is the exception. And as the tax legislation defines life as a predictable useful life ascertained at the time the asset is purchased and not on its eventual disposal, this still complies. Any gain made on a wasting chattel is therefore exempt from capital gains tax. So there would be no chargeable gain in the UK. But also, which is an important point to mention, if the investment proved to be loss-making, you wouldn't have any availability to utilise that loss against any other gains you make, which is obviously also different from other capital gains where you will be paying tax, where you can use the losses. An additional advantage is that while the whiskey sits in its cask in the secured bonded warehouse, it doesn't incur any duties or VAT. So it is very much tax-free. Okay. So eventually the whiskey will mature and is ready for bottling and distribution. So this gives a number of options to the investor. Usually the investor will sell the cask prior to bottling, either back to the investment company or direct to a bottler, and the profits of the sale will not be liable to tax as long as you sell the cask whilst it's still in the bonded warehouse. So this makes investing in whiskey casks a highly efficient tax option for investors in the UK. If the cask is bottled whilst you still own it, so you decide to do the bottling or you still own the cask and it gets bottled, then you will be responsible for duty and VAT because it's now considered leaving the bonded warehouse. So you no longer have the protection that you will have while you own the cask. And the whiskey then becomes a regular chattel, no longer a wasting chattel. And so if the sales value is over £6,000, you could be liable for capital gains tax of up to 20%. And you will have to get licensing and everything else. But I'm sure the guys at VCL can talk you through that if you decide to go down that route. And as an additional consideration, you might need to pay income tax on the profits if HMRC consider you to be trading rather than investing, depending on how often you do this. But that's more for the bottling than it is for the holding of the cask. Right. Okay, so HMRC's view of the treatment of bottled wines and spirits was first set out in a Tax Bulletin 42, published in August 1999. This focuses on the availability of the chattels exemption. And there's a quote of the actual section numbers where you can find it, and the wasting asset exemption. So these are rules that are in tax legislation. So it's not something that's been made up. It's not interpretation. It's actually in the tax legislation in black and white. HMRC have issued a help sheet as well, which these help sheets are used by tax advisors like myself, and they are also used by HMRC staff. So they can, and it's titled Wasting Assets, Wines and Spirits, and it has all these rules in it. So I'm saying there's no interpretation here. It is there in black and white. The other area, obviously, which I said is whether HMRC would consider it to be a trade. So I've just thought I would just talk a little bit about the badges of trade, which are the key areas that HMRC look at in determining whether you're trading rather than investing. So the key areas are the profit-seeking motive, the number of transactions, the nature of the asset, existence of similar trading transactions or interests, changes to the asset, the way the sale was carried out, the source of finance, the interval of time between purchase and sale, and the method of acquisition. So during my research for this webinar, I came across a very old case in which HMRC did treat an investment in whisky as a trade. However, this dates back to 1942, and I believe guidance and knowledge of the sector has moved on since then. In this case, the taxpayer was a woodcutter who bought a consignment of whisky in bond. He subsequently sold the whisky through an agent at a profit. Within the decision, the judge stated, the purchaser of a large quantity of a commodity like whisky, greatly in excess of what could be used by himself, his family and friends, a commodity which yields no pride of possession, which cannot be turned to account except by a process of realization, I can scarcely consider to be other than an adventurer in a transaction in the nature of trade. I mean, I don't think they would use language like this these days, but most important of all, the actual dealings of the respondent with the whisky were exactly the kind that take place in ordinary trade. And in this case, HMRC did charge the individual to income tax rather than capital gains tax. But as I say, now since 1999, there have been rules in place, so hopefully this wouldn't happen. Okay, how it works practically. So the cask is considered a wasting asset, and therefore it is treated in exactly the same way as other wasting assets, an example of which would be your private car. When you sell your private car, you don't include that on your tax return, and neither would the sale of your cask. So this applies, as I said, to both profit and loss. So if you buy a car and you sell it at a profit, you don't pay tax on that profit. If you buy a car and sell it at a loss, which most people do, you don't claim any relief for that loss either. And the same applies for the casks. The rules only apply as long as the cask you're buying and selling are in bonded warehouses, both at the point of purchase and sale. As soon as you move the cask out of the warehouse or bottle the whisky, then it's a very different tax situation, as mentioned previously. So for non-UK residents, so the rules I've talked about up until now are UK taxpayers, are UK residents, because capital gains tax, the wasting chattels, you need to be UK resident for that to apply for you. So there are two key areas that I understand I've been asked to look into, and one's the United States and one is Europe. Okay, so the tax system in the US involves paying federal tax and state tax. The regular federal tax on long-term assets is 23%, and these have to be held for a year. And then there are items in the US that in the UK are considered chattels, but in the US they call them collectibles. And these have a higher tax rate at 28%. However, I understand there is some discussion about whiskey casks as to whether they would be classified as a collectible or whether there is an exemption, again, in the US for this. I'm not an expert in US tax, and although I've spoken to a few colleagues who are in the US, I would highly suggest that you seek advice from a local tax advisor if you are looking to invest and you're a US resident. In addition to the federal taxes, there are state taxes also, and these vary from state to state, anything between 2.9% and 13.3%. And there's also a number of states, which I've listed on the slide, that don't pay any capital gains tax. And that's the state tax, but you would still need to check into the federal tax. Similar to the UK, if you decided to invest multiple times, there's a risk that you could be considered trading in the US and could be susceptible to the higher income rate taxes, the income tax rates even. Other options would be to consider the use of an LLC or a corporation. But again, these have, oh, I apologize, my dog. Again, these come with their own tax rules. Okay, in Europe, the tax system in Europe is a very difficult one for me to just, it would be a whole webinar in itself because every country in Europe has its own tax rules. So from the research the small amount of research that I did, they vary from no capital gains tax up until Denmark that has a 42% capital gains tax rate. So again, let me just have a look. Sorry, I've put some on the next slide. So there's a few few of the countries that I've put on here. So that we've got France that has a flat 30% capital gains tax. Germany has 25%. Luxembourg has none if the asset's considered movable. So possibly these would come under that. But again, you really need to take local advice because I can 100% give you advice about UK tax, but I'm no expert in the Europe or US. Okay, planning ahead. So inheritance tax. Another tax that's often forgotten about is inheritance tax. This is the tax charged based on the value of a deceased person's assets. The rules for capital gains tax are totally separate from inheritance tax considerations, and being exempt from capital gains tax does not mean there's an exemption from inheritance tax. Every individual has a tax-free threshold of £325,000, and for married couples, this can be preserved and utilised by the surviving spouse, giving them £650,000, because anything left to a spouse is free from inheritance tax, but anything in the estate, once you exceed the threshold, is taxed at 40%. So this is a really important consideration and something to consider if your investment is for inheritance tax purposes. So quoting from the legislation from the Section 160 of the Inheritance Tax Act 1984, it states that for inheritance tax purposes, the value of any property is the price it might reasonably be expected to fetch if sold in the open market at that time. Therefore, it is clear that assets must be valued at their open market value for inheritance tax purposes at the time of the relevant charge. So should your investments form part of your estate, they would be valued at market value, at the market value at the point you died. So you wouldn't have your capital gains tax exemption at that point. If you are considering holding the cask in joint names, this would work to reduce your inheritance tax, but the proportion held by you will still form part of your estate at the point that you pass away. So if you are considering using these investments as part of inheritance tax planning and want it to fall outside of your estate, you could gift the asset. This gift would be known as a potentially exempt transfer, which we called PETs, and it starts a 7-year counting down clock. As long as you survive 7 years from the date of the gift, this totally falls outside of your estate for inheritance tax. Then there is a sliding scale. So as long as you live for 3 years, from year 4, there's a sliding scale. So you don't get charged 100%. And I actually can't remember the rates offhand, but there is a sliding scale from after year 4. I do understand there's an issue gifting whiskey casks to minors for obvious reasons. So the way around this would be the creation of a bear trust. Again, this falls under the 7-year rule, and you would need to arrange for a lawyer to put some deeds in place. However, deeds use standard wording, stating that the cask being in trust until the minor reaches 18. By putting the cask into trust means that you would be a nominee on behalf of the intended beneficiary. It would be an absolute gift. So when your child or grandchild turned 18, they would have ownership of the cask. On a practical level, as no income will be received from the trust, it's outside the scope of the settlement legislation. So you wouldn't need to be filling in annual trust returns or anything like that. You wouldn't need to have a UTR. There'd be no tax to pay on it on an annual basis. However, you might need to register the trust with HMRC just as a one-off registration. If you are considering this for inheritance tax purposes, this is definitely something that you could speak to me or speak to another accountant about, because there are definitely things you can put in place to avoid inheritance tax on this, but you do need to plan it because of the 7-year rule. Okay, then I just got a little bit about me and my firm. So that's so this is just a little bit saying where I've come from. So I work at a firm called Gerald Edelman. We're a mid-sized London-based firm of chartered accountants and tax advisors. This is the bit I didn't really plan, so hey, you can read the slide. How about that? But yeah, no, I mean, I've worked in tax for 17 years now, and things have changed a lot in that time. But yes, I'll just put this. I'll show you the slides that my marketing team wanted me to put on, so you can have a read about my firm, because I'll get told off otherwise.
You got to sell it.
We can go on to questions. So
yeah, cool. Well, Simone, thank you very much. Anyway, thank you for your help. And thank you guys who have attended in the questions. We're just going to rattle through a couple. So Philip, you've asked me a question about making the investment. How often is it valued, and where can you see your evaluations? From an investment point of view, your valuations happen every year. Obviously, whiskey is more of a long-term strategy when it comes to investing. So our evaluation process is year on year. You can obviously get an update from your broker at any point you wish to. So if you drop your broker a line, perhaps 6 months in, I would probably say, or every quarter, just say how we're getting on. We can give you sort of a rough idea on the evaluation, but to get that sort of full valuation, you want to wait year on year for that. That's all done hand in hand by our brokers. So the broker will send you an evaluation via email. Then a phone call would be set up with the broker. You can discuss it further in detail and go about how that evaluation is found. So that is there to answer your question. I have another question, which I think will probably be more me as well, Simone, just in regards to exit strategies about bottlings and tax on bottlings. Is there capital gains tax when you look to bottle and sell a whiskey? Simone, you might be able to back me up here, but if you know any knowledge around this, but from my knowledge, there is a tax when you sell bottles of whiskey as well. So either way, when it gets into that bottle, the duty is paid and the tax will be paid. You would agree with me on that one?
It becomes a chattel at that point. So it would really depend, because if your cask of whiskey, let's say, I don't know how many bottles you get out of a cask at the end of the day.
Yeah, a cask will vary. I mean, hogshead's common, so you're looking at anything from sort of 250 bottles to 350 bottles. Rare occasions will have a butt, which is anything up to sort of 600 bottles. But your most common, if we're looking at a law of averages, is 250 to 350.
So you would definitely be talking either capital gains tax or income tax if HMRC deemed you to be trading, if it's something you did on a regular. And obviously income tax rates go up to 45%. Plus possibly national insurance as well. So yeah, you definitely want to be seeking proper tax advice on a personal and individual basis if you consider bottling.
So we obviously at VCL offer many exit strategies. Our main focus on exit strategy, and this touches on Yogesh's question as well, is buying as a cask and selling as a cask. So if we sell it as a cask in bond, there'll be no tax there. Okay. So it'll be a simple transfer of ownership when we make that sale. That's often to a private buyer who we work with. That person may go on and bottle it. That's completely fine. Let those guys do that. Not an issue at all. In terms
this is linked to linked to another question in there as well about moving it out of bonds, because at that point it's not covered by the legislation, by the rules, because part of the rules of being the wasted asset is that it's retained in the bonded warehouse.
Correct, exactly that. So why we wouldn't move a cask from storage but not bottle anyway? I mean, I'm not sure many people want a cask of whiskey sitting in their house, first of all. It's going to take a lot of storage up your ish, and also at the same time there as well, it's better kept in a bonded warehouse because the environment is set for that cask, and it's also around the other oak barrels which it'll be held with. So that's why we keep it in storage. We can transfer it from warehouse to warehouse. That's not an issue at all, as long as it's staying in bond. So we don't tend to take a cask out of storage and ship it to your house. If that's sort of why we would do that, there would be no reason for. So I hope that answers your question there. There's one about inheritance tax there. Do you want to touch on that, Simone? Can you see that?
About the nil rate band?
Yes. So anything you can touch on that?
Yes. So the residential nil rate band is something different to the general inheritance tax nil rate bands that you have. They are two separate things. So one is to do with your home that you sell, and one is to do with all the other assets as part of your estate. So I think it's just sort of cross purposes, actually.
Okay.
Sorry, cool. That really emphasizes that. I hope that, yeah.
And then what if a chattel was given to you as a gift and then sold on years later as well?
So that's fine. I mean, yeah, I mean, it's still, as long as it's retained in the bonded warehouse, it still retains its tax status. There's no issue with that for tax reasons. And because it's a wasting chattel, it doesn't actually even matter what the market value is at the point you received it as a gift. As long as when you sell it, you're still selling it in the cask. You're still under all the rules.
Yeah. What would be an estimate number of casks someone needs to own/sell to be considered as a trader and not an investor? I mean, from my side point of view there, this is, again, touching back on the strategy we have with this investment, which is long term. We're not looking to sell a cask every month, or we're not looking to sell a cask every 6 months. I mean, that's not how we go about business. This is a long-term strategy. You need to hold these casks for 5 years and more. Some people will hold for just under 5 years, but we do a minimum of 3 years. And even at 3 years, if you bought 5 casks, we wouldn't sell them all at once. That would definitely be deemed as trading. We go on a longer-term strategy. We want to schedule it out over the years, as opposed to doing it year, let's sell 5 at once. So that's how we first of all do not pay tax on that, but also in terms of seeing a good profit, you're going to have a better profit strategy going out of the market in terms of your exit end if we're graduating it over many years, as opposed to doing it all at one hit or in quick succession month on month.
Shall I cover on the BPR question that was asked as well? So the BPR is business property relief, which is a relief that you get if you've got a trading business at the point you die. And there's a relief that you don't pay inheritance tax on that. But what you're buying here is you're not buying shares in a business. You are buying an investment. You are buying an item, which is a chattel. So it doesn't come under BPR. If you were to buy them as part of a company, even still, they're investment. So if you bought it under a company, it would be an investment you're buying because it's not a trade. BPR is there for trading companies.
Cool. What is the definition of trading? Is a trade a cask or single purchase transaction, several casks? I think we kind of touched on that last question there as well. Again, if you're trading, you're looking to buy and sell in very quick succession or selling at multiple times. Again, it's a long-term strategy. We're not looking to buy and sell in quick succession. We're looking to get this as much growth as possible, because you always go back to how a cask looks to make a profit, and that is from maturation. The longer it matures, the older it gets, the better the liquid gets, and the more profit you'll see as an investor.
I think also if you're investing through VCL, because you're doing it through an investment broker, that gives it a better investment status. So it's not you going out and trading yourself.
Exactly. And that's why we have that Wilder license we talked about earlier as well, that allows us to buy and sell the alcohol under bond. and we're not doing that in quick succession, as I said. Could you put one cask into a trust to mature in 18 years, retain a cask to managed as a shorter-term investment for a child? How would this fall in the tax line? I mean, in terms of putting a cask in a trust, we tend to avoid that as much as we can. Too much. We get the question asked quite a lot. Leave it in there for 18. Leave a cask for 18 years, though. Yes, please do. That's going to make some good profit there because it's at a longer period of time. When you retain a cask on a shorter term for an investment for a child, again, depends on definition of shorter term. We don't want anything under 3 years. I mean, to be honest, we don't want anything under 5 years. We try to keep it 5 years and above. Have you got any answers to that question as well there, Simone?
I was going to say, obviously, the trust that I talked about being a bear trust is not a trust in the nature of sort of big trust.
Yes,
the bear trust is like holding a bank account in your child's name. So it's very much just paperwork, and you're just holding it as a nominee for your child. So it's a slightly different version of a trust, and that probably would be that's quite a clever way of doing it, because obviously you can't put it in your child's name being under 18.
Yes, exactly. Yeah. So because obviously the child is under the age of 18, you can't hold any alcohol in the name. So we will not allow child names to be on any paperwork or documentation unless they're above 18 and can provide ID for that. We take ID on every time a client invests. We have to do an AML check on every single client who does invest with us. That check will be done, matching your IDs. So we would find out straight away whether they're 18 or not. So we just have to make sure that they're above the alcohol limit age as well. And obviously in the US, it is 21. So likewise with the US, we have to fall in line with that law as well. And I think that is all our questions by the looks of things.
Oh, I got away with it lightly.
Yeah, we did indeed. Well, thank you everyone for tuning in. There will be another series coming out within the next month. We will be doing this every single month. So there will be a different webinar every month. There's some information about Simone and her firm. But Simone, I just want to say a massive thank you from the team at VCL for jumping on this and helping us out.
No problem.
Anyone who needs any advice, please do get in touch with Simone and her team. And likewise, if you need any advice from us, please just reach out to the guys at VCL, whether it be myself you speak with or one of our brokers. Any questions you have, or if you're looking to invest into whiskey, just drop us a line and we'll be happy to help with any questions you do have. Thank you very much, and have a great bank holiday, everyone.
Thank you. Bye.
Perfect. Thank you, Simone.
Oh, you have another question. You've had a late question.
Can a cask sold in auction remain in bond? Yes. If you buy a cask, if you buy a cask anyway, you need to have a Welga license, no matter what it is. If you go onto an auction website, whiskey auctioneer, etc., you will have to have a Welga license to buy that cask. So that Welga license is important for that. Okay. Good stuff. Right. I think that'll be the end of the questions now. Thank you, everyone. As I said, have a great Easter, and feel free to reach out to myself or Simone for any more questions you have. And enjoy. See you later.